Thank you, Cindy, and thank you everyone for taking time today. My name is Mike Reynolds. I manage Freddie Mac's single-family CRT program, and I'm very happy to have Christian Valencia and Jeff Shu join, who respectively manage the capital markets execution and our reinsurance execution. And I think many of you know us well. What we'll do is we're going to we'll look back on 2022 a little bit and, finish the call with a look ahead for 2023, which is probably, most interesting, for everybody. We can go forward, the next slide, next two slides, actually. We'll go forward one more, please. 2022 presented numerous challenges on multiple fronts. First, for Freddie, as an issuer, we were working through the tremendous volumes that grew into our guarantee book, both through 2021, the second half of 2021, as well as through the first half of 2022. As of Q3, Freddie Mac's guarantee book was just shy of $3 trillion. So Freddie Mac as a guarantor saw tremendous growth, and that translated into record-setting new issuance in our CRT programs. We finished the year issuing 19.6 billion, which is up from 19.3 billion in 2021. So that's back-to-back really large volume years, capital accretion years in terms of trying to attract capital into the market. And not only were we extremely active on the new issue front, but between our STACR and our ACES programs, we had nearly 7 billion of call and tender activity. So altogether, nearly 27 billion of cash flows, both new raises and tenders and calls. And so it was extremely busy from that perspective. Of course, there were some big downsides, and it was really the spreads. We saw the year have tremendous spread widening throughout the program. We'll get into the details in a minute, Jeff and Christian, respectively. We saw the spreads particularly acute on the capital market side, and that makes us as an issuer, makes it very challenging for us to issue economical trades. We effectively got pushed out of selling the B2s. We even moved out of the B1s, to a lesser degree. So that was challenging, and number of factors, of course, were driving that. Volumes, contributing factor, liquidity, Fed actions, contributing factor. One thing that, forward looking, probably there's some concerns with the macro environment and the future losses, and that's fair. But, we will say as we look back, the actual losses to date have continued to be very low. And we'll dig deeper into it, but, that combination of the macro environment as well as Freddie Mac's loss MIT programs, we continue for our on-the-run business actual loss transactions. There is not a single transaction that has more than 2 basis points of loss. So loss levels continue to be very low. Next slide. Just to touch base, and Jeff will go into more details in a minute. ACES reinsurance front, extremely busy. I'll kind of point out that very last bullet at the end. I think we were able to do a couple of unique things with our reinsurance partners, and I thank you all for that. Certainly with our cash out refi loans, and then particularly with our forward transactions. And those forward transactions have a tremendous amount of value to Freddie because we're really able to match up when we go long the credit risk via issuing the guarantee and offloading the credit risk via these ACES forward. So that was tremendous work, and kudos to all the folks on our team, but certainly kudos out to all you market participants in that space, including rating agencies, and particularly our broker dealers and our broker agents in the reinsurance front. We really, really do appreciate all that you've worked together. We think it's a great partnership. And I will say, from a calendar year perspective, 2022 capped 10 years of CRT. We launched in 2013. It was later in the year, but just from a calendar year perspective, we just hit a decade, and I do think we've come tremendously a long way. And I'm very happy to say I've been here every step of the way here at Freddie. With that, I'm going to turn it over to Christian to take a little bit of deeper dive on the STACR front. Christian.
Thank you, Mike, and thanks everyone for joining this call. Can you please go to the next slide? So as Mike mentioned, 2022 was a record year for Freddie Mac. On the Stacker program, we issued over 13 billion of notes. It's about a 15% increase versus our 2021 volume. These also had a record of investor participating in the space. So I'll probably go into more detail with that. But in addition to our issuance, we had a strong activity on the tender front. We bought back 5.6 billion of notes in 4 transactions throughout the year. This included 35 unique CUSIPs that were bought back. You know, it's a good way for us to be able to provide liquidity to the space in a time where one of the key concerns from the market was the issuance volume. You know, as Mike mentioned, there was so much originations during the second half of Q1 and the first half of 2022. So with that, we were able to do these tender offers, and you know, we did made certain enhancements throughout those tender offers. So with the first tender offer that we did in the first quarter with the TO1, we streamlined the process, and we went from a 10-day period to a 5-day period to get these tenders executed. Then as we went into the TO2 transaction, we added trust notes. So in the past, we had only bought debt notes. We added trust notes that added additional complexities with new parties that were part of the transaction, asset managers. And we also had like the largest tender offer of the year with near 2 billion of bonds being bought back and providing, again, that money back to investors to be able to reinvest in the space or to fund some of the liquidations that it needed to fund through that. So it helped, I think, the market throughout those times. Then as we went into TO3, one of the things we did is we mixed now inclusion of debt and trust notes. So that was another enhancement to be able to buy both tender debt deals and trust deals in one transaction. And then in TO4, what we did is the first time we bought a B1 note. So, you know, that was something that was being, you know, raised by investors. Okay, these deals have delevered significantly. And when is Freddie Mac going to be able to take advantage of that? So throughout those transactions that we bought in 2022, we were able to, you know, manage our book, and this was a way for Freddie Mac to reduce some of the expenses that we had, but also without bringing in additional capital requirements or bringing in more risk to the company, which was very important for us throughout this period, especially as we were looking at, you know, in the second half of the year, there was already some housing depreciation in the space. Also, something else that we did was we had a couple of call options. These were 2 call options that got to the 10% pull factor. These were fixed severity transactions, one from 2014 and one from 2015. We haven't been active yet in the call in space because, as you know, our calls had 10-year options, but that really started with our 2015 transaction. So we won't have any term calls available until 2025. With that, I'm going to pass it to Jeff, who has been very active in the call space, and to talk about the calls in the reinsurance market.
Thank you, Christian. We did have, as you noted, we have been very active, and in addition to new deal activity, which was very substantial, as Mike pointed out, 6.8 billion last year. We also were facilitating call options. Why don't we go to the next slide and we can take a look at what we did in 2022 for ACES calls. So we had 11 deals that we've done to date, called to date. The call on the ACES side was introduced in the middle of 2016. So we started to see in 2021 some of the calls, the 5-year calls come up, and we were executing. Obviously, given the amount of HPA, the amount of house prices and equity buildup, the exposure ran down, and when we look at the call and the exercise and exercising the call, made a lot of sense to us. So you saw us consistently executing each call that came up beginning in 2021. Throughout 2022, so 8 deals in 2022 for a total of 1.2 billion in RIF. You'll note that 2017 deals, for the most part, we did one 2018 deal that had a 4-year call on a 15-year loan product deal. So we were able to execute through the schedule, and we'll talk at the end about more anticipated volume there, but the call has really been executing efficiently as expected. Why don't I pass it back to you, Christian, for the next slide?
So as we looked at 2022, we had a significant increase in investors. If you look at the previous high was 117 unique investors, and we had to go back to 2015. The last couple of years, we had seen over 100 unique investors in the space, and then 144 in 2022. But like Mike mentioned, a lot of these was related to a spread widening. The reality is that as the spreads widened, we did see other participants come into the space. We had 37 new investors that came into the Stacker program alone, in addition to over 15 unique investors that were recaptures that had not participated in the space since 2021. So we had, you can think about that as over 50 new investors in these 144 unique investors for the year. And we've surpassed over 280 investors in the program to date. Another important fact is we had over 55 unique investors in all our transactions. We're showing you there by each deal, and also the record number of investors for one transaction, which was the 2022 DNA3. We did started to see a drop of investors, especially on the last transaction of the year. That was partially the fact that we were not issuing Bs on that transaction, and also as probably some of these investors were starting to see some of the concerns on the credit side. That was not the main reason for the spread widening at the beginning of the year. A lot of the spread widening was more related to not housing fundamentals, but to more technical issues that I will go into more detail in the next slide. But with that, I'm going to pass it on to Jeff, who has also seen a significant amount of enhancement in the investor participation on the reinsurance space.
Yeah, thanks, Christian. And really, if you look at the next slide, the program has grown substantially in terms of reinsurers that have ever participated. We're up at 53. Very happy with the size of that panel and the growth through the years. And that growth, you can look at even the last few years. We had uncertainty related to COVID. Our numbers still went up. We were adding reinsurers that saw the opportunity in mortgage credit, fundamentals of housing holding strong through that crisis. And so this is, as Mike said, 10 years in. It was hard to envision at the time in 2013, where we had one reinsurer backing a single $75 million deal, that we would be at 53 at this and such a well-supported program. So thanks to everyone who's contributed. When you look through the course of last year, so we had our largest, the high water mark for participation at 30 in the first quarter and 31. That we've added through the year a couple of new additional participants, so that by the end we had 33 unique participants for the year. But that largest panel coincided with the largest transactions in the first quarter related to SPL1 and SPL2. So you can see here, very good, strong returning participation, along with a few new reinsurers here. Looking forward to adding more to the panel. I think interactions, there had quite a bit of interaction a couple of weeks back at a local DC conference with many of you on the phone. That relationship between Freddie and reinsurers, I feel, is very strong. Continues to add a lot of good capacity, reliable capacity to the CRT program. Christian, I'll hand it back to you for a discussion on price trends.
Yeah, so this slide shows you a little bit of like where spreads were at the beginning of the year, the blue line, then where spreads were at the whites, the light blue line, and then the gray line where spreads ended at the end of the year. That shows this significant move in the spreads from the beginning of the year to the end of the year, which resulted first in us retaining some of the classes as we move throughout the year. In Q2, we retained some Bs and partially Ms. Q3, we retained Bs. And at the end of the year in Q4, on the capital market side, we held issuance across all classes, just because at those spreads, it was not economical for us to issue deals. What really led to that? There's a couple things more in the technical front again. One of them, global macro environment, Ukraine, Russia war, rate hikes, started in June 75 basis points hike for the first time in many decades. In addition to that, we saw continued rate hikes and mortgage rates move from 3% area to north of 6.5%, close to 7%, and fund redemptions. And on the fundamental side, in the second half of the year, the home price declines of around 5% from June through the end of the year. So with that, definitely we said that doubling or tripling of spreads, if you look at the M1A, went from 100 to 300 on the wides, and on the B2 from 710 to 1350. So more like 3 times at the top of the stack and around a little over 2x at the bottom of the stack. We've started to see these spreads come in over the last couple of weeks. I would say the last month and a half. And hopefully with that, we'll be able to be more active in the space. I think we'll provide more details on that, but definitely a big move in spreads. And I'm gonna pass it on to Jeff, who has seen a more stable spread move on the reinsurance side.
Thanks, Christian. So if we could go to the next slide. So we show beginning to end of year changes in price. I did want to point out, we also did, of course, reinsurers assessing the uncertainty in the macro environment and trends in housing. And with that, we also did see some meaningful price increases through the course of the year. We also had demand for reinsurance at an all-time high. So you had both Freddie and Fannie very active in GSE CRT. Of course, we also had the primary MI companies that were also very active and shifting some of what otherwise would have been ILN activity to excess of loss or quota share transactions last year. So it was a much more active market and a lot of demand for reinsurance, certainly many opportunities for reinsurers in terms of spending their allocated mortgage credit capacity. We had many conversations through the course of the year. The first half of 2022, we had our 2 largest quarters of purchasing activity. Certainly for some, did put a strain on annual budgets for mortgage credit. We were very active and trying to get good transparency in terms of where mortgage credit capacity stood as we got later into the year. But if once again, I'd point out in the chart where we talked about the number of participants actually held strong through the year. Right, by the end of the year, in that last slide, you saw that there were 17 participants on our last 2 transactions, but that's because we were bringing a single layer as an M1-like layer to the market. So the largest M1 was supported by the largest M1 panel of participants. So with that vast amount of demand, with the uncertainty in the macro environment, with the changes in borrower credit that we saw related to moving from a refi, also COVID underwriting, which had been very, very conservative, and some decreases in average FICOs and rising DTIs, we did see some changes in price throughout the year. All of that amounted to some price changes. So if you look at the curve, we had fairly straight shifts in across the board. We had substantial increase. Some of these levels, especially on the bottom end, we've seen before. Top end M1 pricing at 235, certainly elevated, well above historical rates. But we did see, I think, a pretty steady increase through the year. While prices were increasing, we were talking to reinsurers about their view of credit and what was driving their quoting behavior. It did put pressure. The rise in price did put pressure on our ability to meet our economic threshold. So when we look at each transaction, we have to judge these under an economically sensible test. And it did affect, as you saw, in capital markets, and it began to put us in very at risk, in terms of structuring and bringing new ACES transactions to market, given where levels were. But we were able to get through the year, still found economically sensible transactions, and completed our objectives for CRT. With that, I think we'll talk a bit about trends in loss mitigation and performance. So I want to turn that over to Mike.
Thanks, Jeff and Christian. So of course we're selling credit, and so the actual losses is extremely important. Loss mitigation, when at the beginning of the year, I think all eyes were on modifications. The payment deferrals were a fantastic program that we adapted to respond to the uniqueness of COVID. As we started to encounter, as we offered payment deferrals to as many folks as that needed it, there were certainly some folks that needed to go into modifications. And so what you saw at the beginning of Q1 22, an increase in modification activity. But since Q1, that's steadily sailed off and started to decline. So that story didn't further emerge. And I think, when we look at the right-hand side, the forbearance volumes, that's a diminishing story now as well. I just, clearly all eyes were focused on this. Now going back to 2020, we watched that decline through 2021. Really wasn't much of a story in 2022. Next slide, please. The bottom line here, on the delinquency front, it's a similar story. We're continuing to see declining rates in delinquencies. Early days, that may have been driven by a denominator effect in terms of fast prepays, but that continues to decline. We do see the elevated rates between high LTV and low LTVs. That's consistent with historical patterns. We'll just remind folks that when you're analyzing those transactions, the high LTVs tend to have lower severities given the mortgage insurance that's at the loan level on those transactions. Next slide, please. Bottom line, when you put it all together, the actual losses, and now this is focused on the on-the-run losses, so like HARP collateral is not included here, fixed rate is not included in here. All of this can be sorted and sifted at your leisure, or any way you want to see it, via our Clarity tool. But so far, the credit performance continues to be stellar. Average loss, 0.3 basis points. Average loss over the transactions, a fraction of a basis point. So when we're talking about pricing credit, actual performance, we have no deal. I said it at the top of the call. We have no on-the-run actual loss transaction with more than 2 basis points of loss. So clearly, very favorable macroeconomic conditions have led into that. Going forward, macroeconomic conditions are going to be more challenging as the Fed tries to engineer a soft landing. But just going to remind you, at the end of the day, what we're selling is credit, and credit over this past decade has been stellar. Next slide, and I'm going to turn it. No, I'm going to do one more. Sorry, one more slide, please. Okay, so now as we look forward to 2023, what can you expect? We're really focused at this point. We may, as we have in the past, we may go, there may be other transactions that we end up issuing, but our primary focus, we're looking at 2022 production. And based on that, based on what we've issued last year, we think that we're going to be in the $4.5 to $6.5 billion range of total issuance for 2023. That will continue to be split between ACES and STACR. with the majority of those placements, we do expect to be in the stacker markets. This pipeline report, which is available to you again, we've made this available on Clarity. What we see here is when you look from January through February, the first thing is the UPB's massive declining, right? So, for the low LTVs, we're at 39 billion. At the beginning of the year, we finish up in the 9-10 billion range. Of course, next, the rates increasing. We start the year with a 3 handles. We're finishing the year with a 5 or 6 handle. The LTVs for the low LTV product or DNA product offering has increased by a couple points, but correspondingly FICO has increased by several points, and DTI's kind of the same. Incredibly, and to me, it was the LTVs for the high LTV is incredibly consistent. It's rock solid at 92s, and the FICOs have been consistent. DTI's maybe up a point or two. On that far left-hand column, when you see CRT coverage, what that means is some of this collateral has already been covered in transactions that we issued in 22. So say the bottom row of the 61 to 80 LTV for the January, you see stacker. So stacker's already covered that deal. The stacker transaction has covered that collateral, and so on and so forth. You can see ACES has covered that. So anyways, this is what we have in terms of looking forward, and we got a few other things. Christian, I'll turn it over to you. Next slide.
Thank you, Mike. So, before I go over the 2023 kind of plans for Stacker, one of the key things that we've been working for several years is, the LIBOR is going away. So with that, we have to transition our legacy LIBOR book. And one of the things we're doing is we're going to be transitioning our LIBOR index contracts into SOFR contracts. And that's going to happen after June 30th, 2023. So we have several types of contracts. One of them is the legacy LIBOR index contract with currently 1 month LIBOR. After June 30th, this is going to have a 30-day average SOFR, so backwards looking, and it would include a spread adjustment for the 1 month tenor that's being set by the ARC. Then for existing SOFR index CRT that have the 30-day average SOFR, those had a language that would allow them to go to term. We're not going to be moving to term based on the ARC recommendation as well as a regulator. And those are going to stay with the 30-day average SOFR. And our new issue transactions will include just the 30-day average SOFR and will not have a term expected move to term. So with that, we made a press release on our LIBOR transition. This was done January 13th. You can go there to look at more details of that announcement, as well as you can go to our reference rates transition homepage. There'll be updates related to this change, FAQs. We continue to work with our regulator and Fannie to work together on trying to make sure that all of this is very clear for everyone. And if there are any questions regarding this, please feel free to reach out to me or my team to discuss any questions that you have. Please go to the next slide. So the other development is that in response to the October 2020 clarification made by the UA Regulation Commission, we're making some enhancements regarding to our disclosure and information that we provide to support EU and UK investors. We're going to be providing updated information, and the information for UK investors is substantially the same as the EU investors. So we're just going to refer for now to the UK investors to the EU resource website. We expect to continue to add FAQs that are provided by some of our investors regarding some of the questions that you have. In addition, really this is the key change, that beginning in February 2023 reporting period, we're going to be providing loan level disclosure in the format set forth in the Annex 2 of the regulation. And this would be done for all new and existing Stacker transactions. And these will be provided monthly and at the time of issuance. Investors will be able to take this information and download the files from our Clarity website. And in addition to that, we're going to be providing additional mapping information that will allow you to look at our existing disclosure and the EU template that is required. As part of the EU Regulation Commission requirements, also we need to provide Annex 12, and we're working with our trustee and global agents to make this information available. We're still working on timing of that, and we'll expect to announce that over the next coming weeks. Please go to the next slide. So going into 2023, investors are key partners for us, as well as rating agencies, dealers, and other participants and stakeholders in the space. One of the key things that we want to make sure is that we are able to see you in person. So we're going to bring in Investor Day back on campus in 2023. In addition to that, we think it's important to communicate with you through our quarterly webinars, providing information similar as today, or other topics that you may be of interest or that we think that are of interest based on discussions that we're having with investors in our different type of conversations. If there's any type of topic that you think would be of interest to you, please feel free to reach out to Mike, Jeff, or myself, and we'll consider that topic for future webinars. Again, to be able to make sure that we're seeing you in person as we move, everyone's going back to the offices. We're going to be attending the conferences related to CRT. So we'll be in Vegas in February. If you haven't yet scheduled a meeting with us and you're interested in doing so, please reach out to your favorite dealer and then let them know that you're interested and we can schedule some meeting then. If not, there's other opportunities both at the New York City conference or ABS East. In addition to that, we expect to continue to do roadshows and in-person meetings to visit some of our investors as well. And now going to many of you probably were looking forward to the reason why you're on this call. So 2023, as Mike mentioned, issuance volume is going to be probably about a third or less than a third than what we did last year. With that, we got to look at, we're going to have 6 to 8 transactions as part of the Stacker program and 1 to 2 deals in every quarter. In addition to that, we expect to be in the market with tender offers, 3 or 4 tender offers throughout the year. It's important to us, like I mentioned before, to manage our book and make sure we are efficiently looking at this. It's been 10 years since we've been issuing CRT, and we need to make sure we manage our CRT book just like we manage any other type of our portfolio. With that, I'm going to pass it on to Jeff Xu, who's going to cover some of the 2023 issuance opportunities on the ACES side.
Thanks, Christian. Yeah, it's nice to be able to talk about in-person activities. Last year it was a novelty for us as we were getting back out a bit. Nice to contemplate having an investor day on campus. So we wanted to note it on our slide as well. That's for investors and reinsurers, everyone to attend. Looking forward to seeing everybody here on campus. If you're interested outside of a standard conference to come and visit, we're able to facilitate that as well. So let us know. We listed a sampling of industry conferences here that we're going to try to get out to and see everyone. Again, it was great to see everybody that could make it into DC a couple of weeks back. That offers a lot of value. The reinsurance relationship and shaking hands on a regular basis has helped to build, I think, a good solid offering here. So wanted to make you aware of some things that we're contemplating attending. And then when it comes to the schedule, we're looking at in the first quarter 2 to 3 new deals, and then about a deal or 2 with subsequent quarters. Some of this is dependent on some structural things that we're contemplating, and that will ultimately determine when we execute on our first transaction. But we'll be out early with our brokers to kind of signal in advance of the timing of that first transaction. In addition to that, we've got 8 call options, 5-year call options that are coming up this year. So you'll see that communication from us. We notify at least 60 days prior to the execution of the call. So it's become a very routine process for us. If you have any comments, around communication, the clarity of each of those call option notifications, please just let us know. We feel like we're in a good spot, but open to any edits or suggestions that you have. So looking forward to an active year, even though as Christian was saying, volume overall will be down. I think you have to think about just the larger context and the landscape of the program. The last 2 years were the largest in history. We did 6.8 billion. We did 8.2 billion prior. If you go back to 2019, that was about a 3 billion year. And so we were averaging somewhere around that 3 billion number. So it is, it's gonna feel like it's a certainly a smaller number, but with each transaction, I know that you have reinsurers have a lot of work that they put in for each one. So no shortage of effort. I'm sure that we'll be looking forward to your support this year. With that, I think we're through all of our regular slides, and now we wanted to move into a Q&A session, and I think I'll throw it to Cindy to kind of walk us through the questions that are lined up.
Yes, I have some questions, and if anyone does have questions, please enter them in the chat box. But our first question is, what is the expected split between Stacker and ACES issuance in 2023?
Historically, we've been running 70-30 Stacker ACES. The ACES spreads held in last year, and so we went even a little bit heavier on the ACES side. I would say we're going to be probably in that vicinity again this year, but maybe very similar if we continue to see big spread differentials between the two product offerings. We may have a larger share for ACES.
Okay. And will the Stacker structure remain the same as it was in 2022?
Well, because Christian chime in, but you have to look at every deal. You have to look at every offering circuit. You have to look at every collateral tape. Each transaction is similar, is unique. It's not similar. So of course that's what people do, but we gotta say that. We're always looking to see how to respond to changes in the marketplace. Probably the most significant change that we've made in my mind was post-COVID, the recognition of deferred payment deferrals as a lost MIT. And the way the structures were set up is those costs the investors are being benefited from the loss mitigation, but Freddie Mac was on the hook. So, we made changes to the structure to make sure that modifications or better paths are shared between the entities. And so I think that was the most significant piece. There may be other adjustments that we make, but we don't have anything to announce at this time.
Okay, thank you. And what happens to the B1s and B2s that were not issued?
I'll take that one again. I'm sorry, go ahead, Chris, do you want to go? Yeah, we're with a $3 trillion book. Freddie Mac has a lot of optionality to use to tap into collateral and sell credit risk on that. And you've seen us do that over the years with our off-the-run transactions, or FTRs. So sometimes we can go back, and even if a portion of the risk is sold on a previous transaction, a portion of the risk is sold, but a portion is retained, we have that ability to go back and to sell that. And that's certainly true with a B1 or a B2 entire tranche. We have that option to sell it. That might be something that we could do. Certainly if we did, we would never exceed we'd always maintain the 5% risk retention, so we would never go beyond that. So, no firm decisions are on that. Again, we're still, although spreads have tightened over the past, 45 days or so, they still remain at highly elevated compared to historical levels. So, generally speaking, it's less appealing for us to be selling a V2. But we'll continue to watch that, and if we think it makes sense for us to sell a seasoned, a transaction that has more seasoned collateral in it, we'll do that just as we have in the past.
Okay, and this, it looks like it comes in two parts. How come some seasoned B1s are still rated sub-investment grade, while new issue M1Bs with less credit enhancement and less seasoning are rated investment grade? And then he continues, for example, Stacker 2020 DNA3 B1 is a first pay bonds, but only rated BB. How come the ratings of these bonds are not being reviewed?
So I'm gonna turn that to Christian. Of course, I'm gonna just start by saying the rating agencies determine the ratings. So let's be clear, you're asking the wrong party, but with that, Christian.
Sure, and Mike, to your point, the rating agencies are the ones that are making those decisions. What we do is we make sure that they are reviewing those transactions, and we do have discussions with them about making sure that those are being done on a timely basis. Just the same way that and discussions when COVID happened, and there was a lot of discussion about a potential, could they be downgraded because you expect losses. They took some time to make that decision, and they did immediately downgrade some of the deals. And what's happening on the other side, they're still trying to see, especially given home price appreciation expectations in the future, that has also determination of how they view their models. So I understand the investors' point that this is something that they review. They look at an issue deal differently than a season deal based on the feedback from the rating agency. So that's really more a discussion or a conversation with the rating agency than with us. But what we do is we make sure that they are taking the steps to review the transactions and making the decision based on whatever model they're using.
And I would just add, I would say, generally speaking, we're very happy with the surveillance activities that the rating agencies are employing. We think they take their responsibilities on that front very seriously. We meet with them regularly. They staff, those teams are well staffed, and I understand the complaint that was embedded in the question, but I do think the rating agencies do a great job on their surveillance front as well.
Okay. Actually, one question I will answer. A few people have asked, will meeting participants receive a copy of the slides? This recording will be provided probably within the next couple of days, and it will include the slides. But another one for the group. Any anticipated change in Stacker capital structure for 2023, or any updated comments on intention and ability to retain B1, B2 risk?
Yes. Go ahead, Mike. So we have the ability to retain B1s and B2s like we've done in the past. We will make decisions based on market levels. It's very important for us that the transactions are economically feasible. Again, on the structural changes right now, there's nothing that we have planned, and I think Mike mentioned that before. But when we do, if we do, we will provide more details and discuss with investors, whether it's through the transaction or through different opportunities if we think that it's appropriate, like we've done in the past.
Okay. How many international clients have participated in the U.S. mortgage securities market?
So we don't have a specific count that I can right now share, but let us come back with that and we can try to provide that in the future. I think there's both in the reinsurance market and in the capital markets, there's international investors. We do have what I would say is international investors in the capital market side is more limited, and it's somewhere in the 10 to 15% of our investor base. Maybe Jeff, you want to add some color there?
Just broadly speaking, I think, if the questions around international participation, we've got very substantial international participation, most particularly out of Bermuda. Not a surprise when you're looking at the reinsurance industry, some European participation as well. So we are managing those relationships. Good growth, I think, from large global reinsurance participants.
And it's worth reminding people, we don't have, particularly on the capital market side, we don't have perfect insight into the final resting spots, what portfolios the bonds are landing in. So certainly we're aware of if the primary trade was with a domestic portfolio manager, but they may be managing foreign money. And we certainly try to incorporate that into our disclosures and whatnot to facilitate those investments.
Okay. Are there any changes, for example, reductions in collateral postings in 2023?
Yeah, we won't answer that one. Let's keep going.
Okay. Can you share insights on how you decide which bonds are tendered? Is there any criteria on rating, credit enhancement, or anything that you can share?
Hold on, I'm feeling a little bit bad that I just blew past that last word. I don't know who asked. Look, on collateral, we are aware, particularly in a rising rate environment, that the economic drag for reinsurers related to our collateral requirements is higher than it has been historically. Certainly, I don't think the drag has kept pace with the increase in spreads. Spreads have widened substantially more. So what I'll say is I'll still kind of end with like a no comment, but we will commit to you, Jeff and team, they're acutely aware of collateral, what that means to the transaction. It is on our radar. We have nothing to announce at this time. Then the next question was related to tenders. Maybe you can repeat that for Christian.
Yeah, can you share insights on how you decide which bonds are tendered? Is there any criteria on rating, credit enhancement, or anything you can share?
Sure. So we have a set of FAQs on our website to go over it, so you can go over that. But what we're looking for, there's no set of ratings or necessarily credit enhancement. What we usually look is what's the capital benefit versus where the credit enhancement is. So does the transaction providing capital relief to Freddie Mac? And then the other part is we're looking at how much are we paying for the transaction versus the benefit. So it's there an economic benefit to Freddie Mac in these transactions. So those are the key two things that we're looking at from our side. But additional details on that is in our FAQs in our website.
And one person asked, when is the Freddie on-site CRT investor conference?
We're still finalizing the date for the conference, but once we have, we'll be providing, I think, over the next couple of weeks, a specific date and for people to be able to save the date, and then with a more formal invite closer to the date of the event.
Okay, great. And will the recently announced changes to LLPAs have any impact on Stacker issuance or structure?
At this point, I don't expect that they would, but we would need to do more analysis and look at that. But there's nothing that we've looked at this point that has indicated that there's a change on the structure, given the changes in the LPAs.
Okay.
And I would just add, the LLPAs may affect the collateral mix that Freddie Mac guarantees. And, of course, the CRT is all built off of our guarantee book. So that, that's possible, but to Christian's point, we have to see how the market responds and what gets originated, not only in the short term, but also as we move into a different rate environment.
Okay. Are there any plans to have the B1s or B2s rated with NAIC?
The B1s and B2s, this is more of an NAIC requirement, so it's not something that Freddie Mac is choosing not to rate, but the NAIC does not rate any B notes.
Okay. And then it looks like our last question, is there a minimum required level of capital that reinsurers must maintain in order to participate in ACIS transactions?
So the counterparty team has purview over eligibility, and I'd say what the profile that we're looking at are diversified participants with a track record, right? So showing ability and willingness to pay, and of course substantial surplus. So we do look at the full suite of the profile of the potential new entity. We're currently not working with very any small participants at this point, and the profile has held up, I think, pretty consistently through time. Any new participant has to go through a full due diligence review, talk about the level of available capital, talk about risk management practices. We take a look at your approach to PMLs, take a look at your track record. So it is a high average rated entity. It is a diversified entity. If you look at who we're working with, global in nature. So pretty robust. I would say some feedback we get is that we often, it feels like a rating agency review when we go through these very detailed counterparty assessments. So it's not easy to get through, and we're looking for a very robust counterparty to take on the scale that we're transferring out to market. So if anybody has questions about eligibility, please reach out. Happy to have a conversation on eligibility for a particular entity.
Okay. Well, thank you very much. We appreciate your time today. As always, please reach out to Jeff, Christian, or myself with any questions. Give us suggestions for our upcoming next webinar. We'll be doing that towards close to the end of the quarter. And have a good day. Thank you.